Wall Street has a way of complicating investing to the point that you as an investor become confused and feel compelled to pay for a personal advisor or to pay high fees for the latest trendy form of investment. The objective of investing is to maximize your reward while minimizing your risk. Many people avoid investing because they believe it is gambling, which is true for certain investments. However, those are not the ones in which you can invest. For instance, I've heard people refer to lottery tickets as investing, but with a 1 in 20 million chance of winning, that's gambling, not investing. However, about 50% of Americans continue to play the lottery and spend about $70 billion per year on them. This equates to the average American spending about $600 a year on lottery tickets. If they invested the money instead at a rate of 7% compounding annually for 30 years, they would have about $66,224 in their account. Although this is not $100 million, it illustrates the distinction between investing and gambling. Investing is not gambling, since you have discretion over the level of risk you take. Although you can invest in almost everything that you believe would appreciate over time, from art to cryptocurrency to tax liens, the three most stable assets are stocks, bonds, and real estate. They are more stable and dependable because they have a long track record and there is a wealth of knowledge about how to invest effectively in real estate, stocks, and bonds. Supply and demand decide value. The more people who want something and the less there are, the higher the price would go. Before we get started, don't forget to like the video and subscribe to the channel for more content like this. 1. Determine how much you can invest. To begin, determine how much you will spend each paycheck, whether it is $100, $50, or $10. Each little bit adds up, and you should always attempt to invest the maximum amount possible. Bear in mind that the more money you invest, the more money will work for you. Many people make the error of attempting to invest whatever money is left over each month and then never invest. Always strive to pay yourself first, which means investing your money before spending any of it. This is simple to accomplish. By automation, you can automatically deposit funds into your 401k or IRA account before or shortly after your paycheck arrives in your bank account. Therefore, how much money should you invest? Your savings rate is the amount of your income that you invest. The more you save, the sooner you will retire. Your savings rate and the number of years needed to retire are directly related. The quicker you save, the sooner you can retire and achieve financial independence. Start with 10% of your salary and gradually raise it by 1% every 30 days. 2. Distinguish between short-term and long-term investment strategies. After determining how much money you can invest per month, the next step is to divide your investment strategies into short-term and long-term. Avoid the common mistake of consolidating all of your investments into a single account. Investments for the short term. If you need some of your money in the next 5 years, you can avoid risking losing it. A down payment on a home, tuition expenses, money for a car, or money to travel are all examples of money you may need in the next 5 years or less. While you may believe that a savings account is an excellent place to keep your money, the majority of savings accounts earn less than 0.01%, meaning that you are potentially losing money to inflation. Indeed, Americans lose over $50 billion in interest per year by holding their short-term investments in low-interest savings accounts. This is where you can spend your short-term investments instead. Long-term investments. Your long-term investments are any funds that you want to access in the next 10 years or more. Since this is mainly retirement income, you want to optimize your long-term returns. This means that you cannot place this money in a savings account. You want to save it for retirement. There are two forms of retirement accounts, those provided by an employer and those that require self-registration. Employer retirement accounts typically include 401k plans, depending on the form of employment. Individual retirement accounts are non-employer retirement accounts. The most common forms are the traditional IRA, Roth IRA, SEP IRA, and solo 401k. The distinction between a Roth IRA and a traditional IRA is that money in a Roth IRA grows tax-free over time, and you do not pay taxes on withdrawals, while money in a traditional IRA is taxed upon withdrawal, but you might be able to deduct the contribution from your taxes. A Roth IRA is the best choice for new investors because it offers substantial tax benefits over time. There are several excellent locations to open an IRA or Roth IRA. However, MITA Favorites or Betterment and Ally Invest, both of which offer a large selection of high-quality, low-cost investment choices. 3. Determine your risk level. Unfortunately, since 401k programs are usually provided by an employer, investment options and fees are often reduced. This means that it is important to choose your 401k investments carefully. What I normally suggest to new 401k investors is that they choose a model portfolio based on their comfort level with risk. This is referred to as your asset allocation, and it refers to the proportion of stocks and bonds in your investment portfolio. A word of advice: if you are under the age of 35 and beginning to invest in a 401k, the best strategy is to begin with an aggressive growth portfolio that is heavily weighted toward stocks. A traditional asset allocation strategy that makes sense for a millennial is approximately 90% stocks and 10% bonds. If you reach the age of 35 or even 40, it is prudent to change this allocation to approximately 80% stocks and 20% bonds. Although an optimistic portfolio can inevitably fluctuate over time and exhibit greater volatility, this is nothing to fear because you are investing for the long term, and over a 10-year investing period, you will earn more money investing in stocks than bonds. For millennials, saving as heavily as possible in the stock market through their 401k makes the most sense. 4. What goes into your long-term retirement investment accounts? Both the 401k and IRA are investment vehicles that are commonly used to prepare for retirement. They are not investment vehicles in and of themselves. This implies that you must choose investment funds into which to invest. When you first begin investing, there is an infinite number of options, but the majority of the straightforward ones are the safest. I normally suggest to new Roth IRA or traditional IRA investors that they invest in a target date retirement fund such as the Vanguard 2050 fund. When you near retirement, the target date fund automatically changes your investment balance between stocks and bonds, so you don't have to do anything except keep putting money in. As you develop as a more sophisticated investor, the target date fund will lose its appeal, as you can earn higher incremental returns by investing your IRA in a mix of low-cost index funds, which charge lower fees over time. However, there are few better options for a new investor than a target date retirement fund with an ambitious 90+% stock allocation. While some investors believe target date retirement funds are oversimplified, I know some top financial and private investment professionals who use them to invest their own money. 5. Make the most of tax-advantaged accounts by investing as much money as possible. Taxes are a significant drain on investment returns, which is why you want to eliminate them as much as possible. For the majority of new investors, the primary objective is to invest as much capital as possible in tax-advantaged accounts where their money will grow tax-free over time. You should be familiar with two forms of tax-advantaged accounts: 401ks and individual retirement accounts. For millennials, the maximum annual contribution to tax-advantaged accounts is $19,000 in a 401k and $6,000 in an IRA, for a total of $25,000 in tax-advantaged accounts. Before investing in something else, complete this task. If you work for a company that provides a 401k plan, contribute as much as possible to the plan up to the $18,000 limit, or as much as possible to qualify for the employer match. You are not taxed on the amount you contribute to your 401k, but you are taxed on the money you withdraw from it. Most employers provide an employee match, which is simply an employer contribution equal to a certain percentage of your salary. 3% to 5% is average. This is free money, and if you have it, it is an amazing advantage. At the very least, invest the maximum amount needed to qualify for your employer's match. 6. Invest early and often, and as soon as possible. As a millennial, I recognize that even though my new job did not pay well, I did have one advantage: time. Time is the most critical component of investing because money grows over time, and the more time you have, the more chance your money has to develop due to compounding interest. Albert Einstein even called compounding interest the most powerful force in the universe and the greatest mathematical discovery of all time. In simple terms, suppose you invest $100 and it grows 10% over a year, giving you $110 the next year. It grows 10%, giving you $120.10. You continue to earn money on your growing interest, and as you add to that pool of money, it compounds more over time, allowing you to earn money on your money. This deceptively easy concept is what makes investing so successful over time. Compounding is demonstrated simply by the fact that the more and earlier you invest, the quicker your money will expand. Therefore, how can you get compound interest to work for you? If you have $5 or $5,000, the first rule of investing is to begin investing. If you do not get started, You will be unable to earn money and your money will be unable to earn money. It's very amazing how many people keep all of their money in savings accounts out of fear of losing money in the stock market. But the fact is that if you invest in a stock market index fund for 10 years, the stock market will almost always offer you positive returns on your money. I'm familiar with all of the reasons people give for not investing because I've used them all myself. You lack sufficient funds to invest, you are unfamiliar with the stock market, and you are fearful of losing money. Many of these excuses have almost certainly already cost you thousands or perhaps hundreds of thousands of dollars in future earnings throughout your career. It's as if you're squandering money and shortchanging yourself. I'm assuming that if you're watching this video, you're interested in making money and creating wealth. But if you're not investing, those goals are unlikely to materialize. Seriously, investing is the most certain way to accumulate wealth. 7. Keep track of your investments and net worth. When you first begin investing, one of the simplest ways to keep track of your funds is with the use of a free investment tracker. Personal Capital is my recommended tracker. That is it. It took me time to learn about investing, and when you begin investing, you will gain interest. There is no substitute for doing your research and soliciting feedback from others. If you follow the instructions outlined in this video, you'll be well on your way to accumulating wealth and eventually eliminating the need for jobs.